All right, welcome back. Welcome back. We're the Dividend Dudes. We got Brian and Tom and the anonymous dude behind the camera here. We had a topic that we've been wanting to make a video about. I think we made some stuff about this in the past, but it was time to make this again. It's perhaps one of the biggest things that people want is how to build a massive dividend portfolio, specifically the principle or the effect of the snowball effect. So I've been doing it for a while, right? And I think we just need to lead out with the first big question. How do you build a massive portfolio? What would be the first thing you'd be doing?
Well, it's easy. You just get a job that pays you $1 million a year and then you invest it all.
Yeah, there you go. Get rich with a job. No, I think with investing, there's a couple things that are key. One is to make sure that your finances are first and foremost in check. And, you're not paying more than you're getting. And two is understanding compounding interest, AKA the snowball effect. And really, compounding interest is the heart within the snowball effect.
Something that people miss is, Brian's correct, you gotta live below your means first. So no matter if you're making $1 million or you're making minimum wage, you gotta have money left over.
$1 million a year and not a penny to show for it.
Yep, so the first thing that you would wanna do is, first of all, you need money left over. Because if you don't have anything to invest, you will be trading hours for dollars your whole life. And that's not how you end up making money work for you. So if you want a massive dividend portfolio, you need something left over. If it's $10, I started out with like $100. That's all I had. I had nothing. I was a minimum wage guy, $100, that was it. But I had the $100. I said, I need to make this money work for me. And I invested it. And boy, was it scary because I needed to fix my car with that $100. And it was brakes.
Right.
So I went a few months without being able to slow down my car very well.
Priorities, right?
Yeah.
That's fundamental here. So we need to be able to set aside some money in order to start doing this, even if it's $100, like what you're saying. So let's say I have that. What do I do next?
If you have the $100 and it really is for investing, there's a couple things to note about dividends because there's a lot of mistakes that people make when they're first getting started. One, they buy into the hype. There's a lot of hype. There's a lot of big dividend check payers. There's a lot of people out there that will basically sell you snake oil. You have to be careful. So the first thing you do with the $100 is find somebody who doesn't think $100 is a lot of money and has investment money and does well with that. Brian and I have both done relatively well, as you know, over 20 years of investing. So we've seen some of this. So you got to find somebody who has it and has it legitimately. The second thing you need to do is invest defensively, like ridiculously defensively.
It's not a get-rich-quick scheme. You're not buying a stock because it's low and it's going to explode at some point. It's not Dogecoin where it's 8 cents now, it's going to go up to 75 to the moon. You don't want to invest that way.
That's not investing. That's gambling.
Right.
And I will say it in whether it's Bitcoin, crypto, stocks themselves. Investing takes time. That's the thing you have to understand, that the longer you hold the boring Kimberly-Clark or one of these other companies, the better it suits you. And I think we were talking before we started doing the recording here, and we were saying, well, what's a good example? Well, it's kind of like the cost of ownership of a car. The longer if you buy a car brand new off the lot, I mean, it costs you a lot of money to have that car, especially the moment you pull it off the lot. Don't buy a brand new car, buy a used car. But the cars depreciate in value very quickly. So if you spent $50,000 in a car that you can only sell for 30 grand, it costs you a lot to have it. But the longer you have that car, let's say you have it for 10 years, the cost of ownership of that car is very low. When you invest in a stock, and so you're giving Kimberly-Clark, Fastenal, any one of the stocks in our Dividend Dudes portfolio, if you're giving them that money, the $100 that you had, the longer they hold it, if it's a defensive, reliable company, and you know the dividends are reliable, we'll get into that in a minute, the chances of you getting your money back just on the dividends is very high. It increases with time.
Another way you could look at it is you are going to work a week and you put in your hours, your 40 hours in to get a paycheck, and you get paid. Next month, it's that people give you that paycheck again. You don't have to work that 40 hours again. You're just getting that check. And then the next month, they just give you a check again.
Yep.
You don't have to work those hours ever again.
That $100 is a seed. That seed grows. It takes time to grow. Don't plant it and then dig it up next month. So as long as you understand that aspect of it, I think you can do pretty well.
The thing that I was curious about was, did you have some specific stocks to kind of explain this, to show this principle of this growing over time? And because we keep mentioning this 10-year thing, like you got to think long term. Can you actually show that?
Our portfolio in Dividend Dudes is, and we talked about this, it's new, right? So we're only on like month 20, so you really can't see this. And somebody says, wow, 20 months? Yeah, 20 months. When you invest in something, you have to go into with the assumption that you're investing, you're taking your money and you're giving it to them so that they can pay you back for the money that they're getting. They're working for you now. That's not quite how it works, but that's the mindset you got to have. So in my stocks, I've been investing for 20, God, I'm old now, 21 years. So Brian's been doing the same. When you actually look at a dividend check that comes from a company, they increase on average between 9 and 12%. So what we did is we took stocks that are actually in the Dividend Dudes portfolio, and we can show you what happens to those over the course of a period of time. So the one we have, what do we have up here?
This is Fastenal.
Fastenal. Okay, so boring company. They make nuts and bolts. You need nuts and bolts because otherwise you're not going to have a roof on your house.
Right.
Or nuts to hold your car together. So basically what happens with the dividend check is if this company is profitable, and I want to sidetrack just a slight bit, as long as the company is profitable and they can afford to pay their dividends. So there's another trap that people get into. They see a company that says, oh, I pay 20% dividends. We actually covered a few stocks on this channel that promised a high dividend but couldn't actually afford it, and then that paycheck that you thought you were going to get disappeared. That's another reason why when we buy stocks, we pick the companies we do, because we know that you need a roof on your house, or in Campbell's soup you need to eat, and nobody can go without goldfish. You got to have goldfish.
Got to have goldfish.
Nuclear apocalypse, you're going to be eating goldfish. Maybe. But as far as the dividend goes, they pay what doesn't seem like a very inspiring dividend. It's like 2%, 3%. Coca-Cola is pretty low too. And you're like, gosh, that's nothing. You give them $100, they give you what, 30 cents a month? That doesn't seem like a lot.
But look at all the dividends that you're getting here.
So between then and the time that your investment, or if it was like a CD or bond, comes to maturity, you're getting paid every quarter. Every quarter. And look what happened. I've had Fastenal since 2008. So they've had they paid a dividend every quarter the entire time, and they've had a few nice increases to those dividends too. So if you go back to 2011, we don't go all the way back to before the recession and everything, we just start at the bottom. They were paying 12 cents a share, and if you just look at, you fast forward a couple of years, go to 2014 for me here. So if you look at 2014, it's 12 cents a share. Doesn't seem like much. Go to and keep going over. Oh, now they're paying 15 cents a share in 2016. They keep increasing over time. So what happens, and if you look at the stock split too, we can get into that in a different video. When a stock splits, you own twice as many shares, and typically companies will pay you a dividend based on how many shares you have. So
completely different video.
Yeah, completely different video. But that's also, in most cases, unless it's like a reverse split or something, that's a pay raise. So by the time you go from 2011 to today, Fastenal gave you a 300 and almost 50, it's like 330, 350% increase in dividend checks. So if you were getting $10 a month, you're getting a lot more than that. You're getting $35 a month now, just in dividends. And if you look at the stock price, sure, it shows it's going up. Hey, that's wonderful. I'm making more money on this because the principal has gone up. But not only has the principal gone up, your dividend check has gone up. And I can get into inflation and what the Fed does and all of that, but that you don't, for building a big dividend portfolio, we'll cover that in a different video. This is what you need to see, because if you buy a company that pays it promises to pay a really high dividend, say like another one in our portfolio, Devon, we warned about it, it's a lot more violent. I mean, you can see it in the stock prices. The moment they started paying the huge dividend, they're all over the place. I mean, they paid a very inconsistent dividend. So what you're looking for is back to 2011. This is a different company. Devon Energy is a energy company. They do energy storage, energy sales. It's basically similar to, they function similar to like what an energy storage or an oil company would. Their dividend is huge by comparison to Fastenal. However, if you look at what happens with the dividend, it's almost as violent and unpredictable as watching the media. Like one day it's great, the other day it's not. So for the most part, yeah, you can see here 20 cents, 24 cents a dividend. It looks like it's going up. It's looking like it's going up. And then all of a sudden they say, hey, we're going to pay a big dividend. And then you get 6 cents. They had a bad quarter. They had a bad year. It doesn't look good. And well, Tom, can that happen to Coca-Cola? Yeah, it can happen. AT&T just cut their dividend. They dropped it because they were paying too much. But look what happens when, keep going forward here. 9 cents, 11 cents.
I mean, we're looking
10 years.
10 years that they were down 6 cents a dividend. So you're getting used to 24 cents. So for 10 years, they're 6. But now they're going up. $1.27, $1.37, $1.17, 69 cents.
It's violent.
52 cents, 29 cents. So they're very up and down. What you're trying to get is one that gradually increases it over time, always going up.
I mean, imagine if that was your paycheck. Like if you were trying to live off these dividends and it was $1. I mean, man, you got a big paycheck one day and then all of a sudden it goes down to 6 cents. Like, what do you do?
So you're describing being a YouTuber, right?
Oh yeah. It's great one month, down the next.
Yeah, or you say something wrong and all of a sudden like you're, now nobody wants to watch you anymore.
Okay, so I'm hearing you. So we're finding things that aren't violent. I like that word. The companies aren't violent all over the place with their stock. We're looking for things that have consistent growth, which tends to be things that are necessities, is what you're saying. And then the dividends that actually grow over time.
The easiest way to find that is to find companies that produce products that people have to have. Like this is the one that we've got up here on our screen now is called Kimberly-Clark. They make toilet paper. They make paper products. They're a relatively boring company. Again, a company that's not exciting, not something like, you see Tesla in the news every day, but if that was your paycheck, if that was what you were relying on for your money, would you really want to see something sensational about that company in the news every single day?
No.
I mean,
not really.
Not for my paycheck.
The only people that really like that are the people who are doing option trading or something similar where they want the volatility because if they trade the option, somebody buys it, goes up, they make a lot of money. You don't really want that if you are growth investing or dividend investing. Yeah,
and especially if you want to even use some of this income for anything. Like my dividends, I get most of mine on a monthly basis. They're from various companies that pay quarterly. It's the end of the year now, so December of 23. This month I'm getting close to $6,000 of dividends in my personal portfolio. But that's because of like 3 of the companies pay semi-annually. But all of these companies are boring. They're not exciting. But if I had a company that was, that would drive me crazy.
Right.
How do you know how to even budget if you don't even know you're going to get your dividend check?
Like you get a great dividend one quarter, you get a crappy dividend the next quarter. Then it's hard to really budget your life over that because you never know, one, what your dividend checks are going to be, and 2, if that dividend check is going to be there, because there could be a time where they just cut it.
Well, it's just like we talked to Rob actually when we did the video with him. He started talking to me about this crypto thing. I was going to buy this crypto. I told him not to. So because he was just starting out. He was the $100. We have a video about that. But he was just starting with the $100. I told him to buy the most boring thing possible after we get him out of debt. Now we did that. He's out of debt.
Watch that video.
Yep. So that though. We covered another video, just like with him. I told him this. Zim had promised a 30% revenue sharing on their revenue. When you looked at the revenue, it wasn't there. There was a number of red flags that were happening there. But I was thinking of that $100 that Rob had. If that's all he had, and it was trading at $81 a share, now it's $8, like we said. And they cut their dividend. You're not getting your paycheck. How would you feel if you worked hard for some money? And you said, hey, I'm going to give you some money. And not only did the day traders and the option traders, because that's a whole different animal. There's a whole market of people doing this day trading stuff. That if they took that money and they went and they spent it for you and you never saw any of it back. At least with a company that produces products that people need, you know that their income is there. It's not going anywhere. And that you can generally predict, even if it's a small amount at first, that they're going to keep paying you good times and bad times. And we got a doozy coming up in 2024. Like there's a lot of stuff happening. We'll cover that in our monthly stock video. But for your dividend check, I mean, look at Kimberly-Clark here. You go all the way back to 2010. This is the third example we have. 67 cents a share, and you just scroll down the line, you can see that they generally increase it relatively steadily.
They always increase it.
Why do they do that? Well, the Fed's job is to manage inflation. So naturally, money is going to become less valuable because of what the government does with printing money, or the Fed does. And in that case, you're hedging yourself against inflation, and you're getting paid more as long as you do that. And the chances are the company is going to be more profitable over time. So you went from, 68 cents a share to over $1 per share?
Yep.
That's a lot.
So really, now you know how to save money, because we've got videos. You have to save money in order to invest. You know what to invest in. Great companies that have a wide defensive moat, that have dividends that continuously to grow, because you need that, and doesn't wildly shift. How does that come back around to the snowball effect and compounding interest?
Well, you ask a legit question.
You stole my question. That's a good question.
Oh, sorry. Nate, you say it.
No, you're good. That's exactly it. Yeah, you're good.
So, first thing I want to highlight on the snowball effect is this. Your dividend checks by themselves. We're all clear on this. Your dividend checks on Fastenal went from, if you were making $10 a month, you're making 35. If it was Kimberly-Clark, you're making 10. Now you're making like 20 20. You're making about 20. So the dividends themselves go up. But if the snowball effect takes effect, and what that is basically, it's compound interest. So if you don't know what compound interest is, you can do a quick Google search, and that'll tell you everything about compound interest. Basically, the summary of that is the $100 that you give them, you're going to invest the $100. That $100, then if you get a dividend check, you take the dividend check and then you invest that. So then what happens is the money that's working for you starts investing in money that also starts working for you.
Which you didn't have to work for.
Yep, you work for it once, not again. So all those dividend checks that are coming from these examples that we have here, not only did they increase, if you're reinvesting those dividends, the dividends get bigger.
Yep.
Because you're putting more money into the pool.
Right.
We have a whole method on how we go about doing that. But if you were to take, like we did another snowball video some time ago, but if you were to take just the $400 a month that we originally started the channel with, and you took that out over 20 some odd years, you were getting in dividend checks almost $3,000 a month before even 30 years were up. Oh my God, Tom, that's 30 years. Yeah, you're getting paid the whole time.
Right.
Like the whole time.
And it continues to grow, because you take the $100, you get, say, $6 in dividend check, put that back on it. Now you get more shares for that you give even more money. So if you never put into it, that will just continuously compound on top of itself.
You're gonna have my problem after a while, and you guys have seen this. I buy stuff.
If you don't buy it.
If you don't buy stuff with your dividends, it grows faster. But
right.
you can spend the dividend checks on things that you need necessarily. Maybe it's milk. You get a $10,000 check, you can buy 2 gallons of milk.
That's expensive milk, buddy.
Inflation's a killer, dude. But
I don't know where you live. I don't think even Hawaii is that much.
Okay, fine. You can buy more than 2 gallons, but pretty close, right? So the point is that you still have your principal investment in that company.
Right.
So the company is still obligated to pay you the dividend that they paid you last time. So why would you buy a company that you're not sure is going to be around in 10 years? I've had 3 stocks in my career, investing career in 20 years, that I've bought that were high risk, and I've lost money on them. A lot. I tend to average between $40,000 and $50,000 of my purchases. That's not $400. That's not the $100 that you talked about, but that's what I average. So if you're talking just those 3, that's over $100,000. Now I'm still getting paid with dividends. One of them doubled their dividend check on my original investment because I've had them for so long. But if I had panicked, this is how you build a big portfolio. When they dropped, and I knew that they couldn't pay their dividend, and I sold it, then I wouldn't have gotten any money back.
Right.
So when the market crashes, this is key. This is a huge thing for anybody just starting. When the market crashes, you need to have companies that are consistent, reliable on their dividends, so you're not freaking out worrying about, oh my gosh, the stock went from $100 down to 10. And you're still going to get paid. And guess what? If you're in a reliable company, the dividend checks are going to increase. And maybe you too can make thousands of dollars a month in dividends, but you have to buy in such a way and be consistent in those investments with the mindset that this is an investment. This is not something I'm going to turn around in 6 months and say, I'm going to take it out and it's going to be worth $200.
Right.
All the people doing that, they're buying all of the 7 stocks you hear about on YouTube all the time. It's all the big names. You know who they are. I mean, we've covered them before, but in this case, this works. We're living, breathing examples that this actually works.
This is the Charlie Munger quote of never interrupt compounding interest unnecessarily.
Well, I'm doomed. I want that projector and the other car. And
Right. But you're
I think this is
to a point where you can do that.
Yeah.
When you didn't do that just starting out.
yeah.
You allowed that to compound and grow.
I feel like this is the perfect segue into the next question I had. I think what would be valuable to hear is what are some of the mistakes you see people starting out making? So you already mentioned one. What are some other ones?
Check the fruit on the tree. Make sure the people you're taking advice from actually have what you want. We said that in another video, and I say it again. Make sure you get good advice.
Right. What you don't want to do is go to Reddit and like Wall Street Bets or something like that that gives you, this is the stock of the day, get into this now. That's a red flag. Look into that company because you probably are going to see that their income is not there. Their operating income is just going down or doesn't pay their expenses. There's something wrong with that company, but they're betting on the fact that they're making a product or a service that people are going to want that's going to go up.
Yep.
But you really need to look heavily into those companies. So you have to do your own research and make sure that the company has something that people need and people have to have.
Or just watch our channel. We do a lot of research.
Yeah, we'll do it for you. We're not financial advisors. We're not your financial advisor. So definitely watch us, look at the stocks that we recommend, and look into them.
Vet us out,
and
yep.
make sure that we're correct.
Yep.
All right, that is awesome. I had another question for you, specifically as we're building this portfolio here. When to hold versus when to sell?
Oh man, if you want to know when to hold them and when to sell them and when to run away and when to walk,
Don't get me started.
we need to do a video on that. It's going to be in this video.
Stay tuned. We'll have that posted for you.